It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. Well, I have had a really tremendous week meeting with a number of clients and prospective clients. There's a number of them that have been extrememely interesting. So I want to share some of those stories and share what we discussed, because I think you're going to learn a lot. You're going to learn about some financial literacy stuff, what's going on with the economy, what people are thinking now, and also how I operate and how I work with people. So I think you'll find it very beneficial. I do have some economic information I want to share also, but because I've got so much interesting to share with some client meetings today, I want to start there and we'll finish with the economic news. One person I met with today was a review that I did for a client that I met and started working with 19 years ago. So I think you're going to find it quite interesting. But before I go there, I have another one that these are some folks that have been clients for several years, but they did a new account. We did an index annuity 1 year ago. In fact, they started February 11th of 2025. We did their annual review recently. And what I found quite interesting was two things. One, their return for the past year was 20%. I've been sharing this on this show for quite a bit, how these index annuities, if you have the right indexes, you can get tremendous results. Yes, it's true. About 80% of the indexes out there don't perform that well. And that's one of the common misconceptions that, well, really isn't that much of a misconception about index annuities is, if you want safety, you've got to give up some growth. Well, again, about 80% of the indexes out there perform in the low single digits, 3, 4, 5%. That's kind of the norm. And what I typically see when somebody who has an annuity, maybe they've had it for 2 or 5 or 10 years or whatever, we look at their statements and, yeah, they 3, 4, 5, 6%, that's pretty normal, typically what I see. Yet with my clients, we do see 20% returns, but it's not uncommon. We're getting averages over the last decade of 11% plus. Why? It's that index performance report. I've shared this on the show, folks, several times. This is the game changer. The software company that provides this tells me that about 1% of agents and advisors have access to this. There are literally hundreds of indexes. And how is someone going to keep track of all those indexes? It's nearly impossible. Plus, most of it's not public record. It's difficult to find. It's difficult to obtain. And I do believe that most agents and advisors genuinely want their clients to do well. I know I certainly have. But even in my career, early in my career, before I had access to this index performance report, I would look at all these different indexes and try to determine which one might be the best fit for my client. I would take the advice that be given to me by perhaps a marketing rep, maybe some other associates, other agents, maybe experiences that I'd had, try to do some research and make an educated guess. But without the actual 1, 5, 10-year results of what all these indexes have actually performed, you're really flying in the dark. You're running blind. It's kind of tough. Let's put it this way. You're at a definite disadvantage. So that's why when I met with this client doing this annual review, their first year return was literally 20%. If you have had an annuity, maybe you got it a year recently, or you've had it for 5 or 10 years or longer perhaps, and you're not seeing like a double-digit return on it this past year, past several years, frankly, you're either in the wrong product or on the wrong indexes, folks. If you look at the index performance report, and I show this when I do a Zoom meeting with potential clients. And so you see what I'm seeing. You see how the sausage is made. And you'll see 80% of the indexes perform low single digits. So 80% of the annuities out there are not doing that well. So that common misconception out there that exists regarding index products, index annuities, IULs, that they don't perform that way, that if you're going to get guarantees that you have to give up upside gains, is partially valid because so many of these indexes just don't perform that well. But it's the old 80-20 rule. Guess what? 20% of them do. And we have multiple indexes like S&P 5, based on the S&P 500, NASDAQ, etc., that have actual performed returns 10, 11% plus over the past decade or longer even. Those are just the facts. So again, if you are not seeing those kind of results, and if you don't see some 20% returns occasionally, you're in the wrong index. I don't know how else to put it. You should contact me at yourpersonalbank.com or send me an email. It's my first name, Ferenc. It's Ferenc. Again, Ferenc at yourpersonalbank.com. Or if you go to my website, yourpersonalbank.com, my email is on there, or you can call me, and I'll show you the difference. And you can experience a difference of getting double-digit returns on average. Certainly, we have had that for the past decade plus, and sometimes see a 20% return, which is kind of fun. It's fun doing those reviews. And here's the second thing to understand about index products. So these folks did get the 20% return on their index annuity the first year. All index annuity products protect the downside. They protect the principal. But what they also do is once you do get a gain, like these clients did with their 20% return, they now locked that gain in. So if in the future, if the markets or the indexes go down, they don't lose that 20% gain they just got. So each and every year going forward, you're going to have the same amount of money or more. You never go backwards, and that's really powerful. Let's say you had a 20% loss in one year. Does that ever happen in the markets? Of course it does. Some people think we're overdue for one of those. But how long does it take to recover from a typical 20% or more recovery? Well, the historical average is 5 to 15 years. Just go back in history, look at the charts. And I just always ask people a simple question. Do you have 5 to 10 to maybe 15 years even to make up a loss if we see a correction? In other words, get back to even. If you take a hit and it takes you a year, 2, 5, or more to recover from where you were you making any money during that period of time? No, you were just retracing what you had before. With an index product, you get that gain like my clients did. I did this review literally yesterday. They got a 20% return, locked in, first year on their index annuity. Guess what? They'll never have less than that, no matter what the index or the markets do going forward. If that sounds interesting to you, you should contact me at yourpersonalbank.com. But I'm going to go further because there was another thing about this particular case that was really, really cool. I covered the first common misconception about index annuities, index products, or guaranteed products, that you have to give up on the upside, some of the upside to get the downside gains. That's only true if you're in the wrong indexes. And I shared with you earlier how we're able to make sure people are in the best indexes consistently. My clients' returns typically are 2, 3, sometimes 4 times greater than what they were getting before I started working with them. I deal with that all the time. Here's the other limitation that's commonly associated with index products, not so much with IULs, but with index annuities particularly. And it's this. Most index annuity products allow you 10% free withdrawals per year. That's pretty standard. So the negative connotation you'll hear sometimes of people say, well, you're tying your money up. You can't get access to more of the money. But what they don't understand is this. There's something called a market value adjustment. And although this is not guaranteed, I'm going to share with you what has actually happened, what happened yesterday with this client that I did this review with. And this is what I'm running into week in and week out, and I've been seeing this over the last couple of years on a consistent and regular basis. And here's what it is. What the market value adjustment does is the company makes an estimate of what kind of profits they're going to make for that year. And insurance companies tend to be rather conservative for the most part. So they tend to under-promise, over-deliver, which is another thing I like about them. They'll project a profit return they're going to make on their investments. And if they do better than expected, it isn't added to your returns, but what it does is it reduces your surrender charge if you wanted to close your account and walk away. Obviously, the opposite is true. If the company does worse than expected, your market value adjustment could go against you, which means your surrender charge could be higher than expected if the company does worse than projections. Now, here's why that's highly unlikely to occur anytime in the next 5, 10 years plus, probably. These companies primarily invest in bonds. Bond yields, long-term bond yields, are strong. They're much stronger than they were 2-3 years ago. Most of the last decade. The primary reason behind it is the government debt. When the government prints a lot of money, they have to sell the bonds to offset the currency. There's record amount of debt, record amount of bonds being sold, basic supply and demand. How does the government entice all these institutional bond buyers to buy all these bonds? Well, they have to increase the interest rate, increase the yield. So regardless of whether the Federal Reserve raises or lowers its interest rates, it really doesn't do much to affect longer-term bonds, like 20, 30-year government bonds that these insurance companies tend to buy. So the Federal Reserve has little or nothing to do with this. It has to do with the government debt and the bond yields. Now, how do we know when the bond yields are going to go back down? Well, that's only going to happen if the government debt gets under control. In other words, when you start to see the federal debt starting to decline or decrease, then we might start to see bond yields decreasing. Does anyone see our federal government reducing spending, reducing debt? No, they're adding to it. They're adding to it on a daily basis. And there's no movement by Congress to do anything about it at this point. And it doesn't look like anything's going to happen in the foreseeable future. So realistically, and this is what all the experts are saying, bond yields are going to be higher for longer. That's why the Fed has stated interest rates higher for longer. They're really referring to the bond market. By the way, don't expect mortgage rates to go down all that much for the same reasons. Again, the bond market. Now, there's some things I've talked about this is another subject I've talked about in other shows. There's some things that the Trump administration might be able to do to affect mortgage rates particularly, but not the bond yields. The bond market's too big. The bond market is many times larger than the overall stock market, for example. So it's huge. It's hard to, so it's not easily manipulated. It's just too big. So we're very, very confident that bond yields are going to stay, on the longer term bonds particularly, are going to stay strong next 5-10 years, probably longer, which means these market value adjustments are going to work in your favor on these index annuities because these companies are projecting rather conservative profits. Actually, most insurance companies' profits today on their bond investments are double and triple higher than they were just even 2-3 years ago. That's how much of a significant difference we're experiencing. That's why I say this is the golden age of fixed assets. It's the best time in 40 years. This isn't hyperbole. That is literally the fact. So the bottom line is this. With this client, with the market value adjustment, I'm going to share some numbers so you can get a perspective that'll help you understand a little better. So this client put in $315,000 into an index annuity 1 year ago. We did their annual review February 11th of 2026, 1 year later. Not only had they gotten a 20% increase in their investment, so their account value went up 20%, but the market value adjustment was so much in their favor. Not only did this early surrender charge disappear after 1 year, they were actually up $14,000 over what they had put in. So they literally, if they'd put the money in here, put in $315,000, 1 year later wanted to walk out, and this was a 10-year product. It was supposed to have a 10-year surrender schedule. After 1 year, not only they had no surrender charge, they would have walked away with $14,000 more than they put in. So their surrender charge was gone plus. And if they keep the account, of course, they got a 20% return. If you run the numbers, that's $379,000. So they went from $315 to $379 in 1 year. If the markets or indexes correct this next year, they get to keep the $379. If this sounds interesting to you, contact me at year.Personalbank.com. Stay tuned in the next segment because I want to share the story of the client I worked with start in 2007, 19 years ago, and I did the annual review with him yesterday. So stay tuned.
I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, or you can go to the Your Personal Bank app, but it's yourpersonalbank.com. So in the last segment, I was sharing a review I did with a client that opened up an index annuity 1 year ago. We did their first year annual review. Their return was 20%. If you have an annuity, whether you've had it a year, 5, 10, I don't care. And if you're not seeing strong double-digit returns in this past year or so, you're in the wrong index or you have the wrong annuity, folks. Contact me at yourpersonalbank.com. I'll show you how to get into a way better product. Probably double, triple, even quadruple sometimes the returns you've been getting just because we're putting you in better indexes. I'll show you the index performance report. It's like this. If you want to win a horse race, you got to have a fast horse and a good jockey. And I'll put you in the fastest horses that exist out there. I'll show you. That's one of the problems you've got, why you're not getting the returns you should be getting or could be. Now, the second client I met with this week, yesterday, was really interesting. I first met this client in 2007, 19 years ago. He was recently retired, an engineer, very smart guy. So he was 66. He had just shy of $1 million invested in a number of different investments, but primarily typical portfolio, variable annuities, things like that. All of it subject to market risk. He was pretty heavily skewed towards a lot of tech stocks to maximize returns, that type of thing. I discussed index annuities with him, the ability to grow the money, unlimited upside potential gains, no downside risk. He liked that idea. Again, being recently retired, this was an idea he liked. He bought into it. We rolled over, transferred all of the different accounts, again, just shy of $1 million, into some index annuities. 1 year later, so this was 2008, we had an annual review. The NASDAQ had dropped over 40% in that year. What was interesting, him being an engineer, we sat down and did his annual review. And here's the thing, and he was actually quite nervous, as many people were at that time, because everything's crashing, right? We're talking the Great Recession. It's not pretty. Things are ugly. Stated, I've been dreading this meeting with you and what you're going to say. Well, I said, well, first of all, I've got some good news and bad news. He says, I expected that. He goes, hit me with the bad news first. So I said, the bad news is you didn't make any money last year. He kind of looks at me. Well, he said, what's the good news? And I said, well, you didn't lose any money either. He said, I remember you telling me that last year and how this works, but explain to me again how this works, how that was the case. And I reminded him that index annuities, the principal is guaranteed. He had put in almost $1 million into these accounts. Guess what? It was a year later. He still had what he put in. He had almost $1 million. Because again, the principal is guaranteed. He looked at me, he says, you don't know this. He was a spreadsheet guy. He was an engineer. He had kept track of his previous investments to see where they would be at, to track them, to see the difference, to compare. I did that. And I said, really? That's interesting. He goes, do you know if I had stayed where I was, you know where our accounts would be today? I said, no, I'm sure worse, but it showed me $380,000. So he would have gone from almost $1 million to about $380,000. Because again, he was in a lot of tech stocks and such like that. That was what 2008 was like, folks. And as he pointed out, he would have had to gone back to work. He even joked, when we were done with the meeting, he said, all my friends, he was living in a retirement community in Sun City in Arizona. And he said, you know what all our friends are doing? They've all gone back to work. He said, you know what my wife and I are doing after this meeting? I said, what? We're going to play tennis. I said, good for you. He said, if I had stayed where I was at, I would have had to gone back to work too. I said, yeah, I'm sure. But he didn't. Then I reminded him of one other aspect that he had kind of forgotten the year before. Not only there's a principal guaranteed on these index annuities, and index IULs, by the way, also. But each year, then once you lock in a gain, you keep it. So your accounts can go up from there. So I said, here's the beauty. The markets are going to recover from this at some point. And when they do, your accounts are going to go up from the $1 million mark where you are, basically, instead of being at $380,000 where you would have been. How long would have that taken to recover? Well, it turns out, we didn't know that at the time, but going later in time, his accounts, he kept track of it every year. Again, being an engineer, being detail-oriented like that. Do you realize his accounts would have taken 12 years to get back to where he was? Because again, he was fairly skewed towards the tech stocks. And 12 years later, with the index annuity, his account was more than double because he hadn't suffered the downside risk and he was still getting all the upside gains going forward. Then he decided to turn on what we call guaranteed lifetime income riders. His guaranteed lifetime income rider had grown at 8% per year, guaranteed all through that time frame. So it had more than doubled in the 12 years. It had gone up about 2.5 times roughly. And then he was able to turn on the guaranteed lifetime income riders. And based on the account values of not losing the money and letting it grow, then turning on that income rider, his lifetime income today is almost $100,000 a year, guaranteed for the rest of his life. We, again, tracking what he would have done and then assuming the growth, the recovery, and then later growth, and assuming a 4% withdrawal rate, which is what's recommended by Wall Street as a relatively safe or with a high degree of certainty that you won't run out of money in retirement. You want to take about 4%, roughly. His income is about double of what it would have been. So not only did he not suffer the loss of the 2008 crash, ultimately his account values grew, and then his guaranteed lifetime income, again, he cannot outlive this income. That was a reminder of, he's 85 today. And another piece of this is there were some benefits in there in terms of long-term care. We set that up for him too with all this, gave his wife and his wife about $250,000 of long-term care coverage. Not long-term care insurance, folks, but living benefits where if they needed assistance, there was money available for that on a tax-free basis. He used some of that. He had a stroke a couple of years ago. They have about $250,000 of monies available for that for each of them if they need it. And as I pointed out to him as we were wrapping up our meeting, he was obviously quite happy, quite pleased with what we had done. And he mentioned, it seems like a lifetime ago when you and I met 19 years ago. A lot's happened since then. But the plan you put together has come to fruition. And everything that you said was going to happen not only did, but did even better than you said. And he thanked me a number of times. And when I meet with some of my longer-term clients like that, that's typically how it works. And, it just does my heart good that I was able to make a real positive difference in him and his wife's lives. And that's why I do what I do. That's where the passion comes from, folks. So I couldn't have been happier. I love doing those reviews with people that have been with me a long time and follow the advice I gave them and then see it come to fruition. We all understand when you meet with a financial person, advisor, whatever, estimates are made, expectations are made, but there's no guarantees. No one can guarantee what the returns are going to be. But one thing I can guarantee is there won't be no downside. And when you take that downside off the table, Warren Buffett was famous for saying this. Most investors make the mistake of thinking they have to maximize returns when they really, what's far more important is to eliminate the losses. It's a scientific concept called sequence of returns. It's something I taught in a college certified financial literacy course I taught for a couple of years. Typically, any decade period of time, on average, 2 to 3 years of that decade, you're going to suffer some kind of loss. Some are large, some are not, but there's a downturn. 7 to 8 of the years of any decade tend to be on the upside. Well, if you think about it a minute, if you have 2 or 3 downside years, and it just takes just a year each to recover the downside, which doesn't always typically happen, but let's be generous. If you lose a couple of years, 2 or 3 years, and you take 2 or 3 years to recover, well, about half the time of any typical decade is made just losing and retracing old ground. You're only moving forward about half the time, and that's being generous. There was something called in 2000 to 2010 was known as the lost decade. Why? Because the dot-com bubble had burst so badly that most people, it took them a decade to get back where they started. This client I shared with earlier that I did the review, we met him 19 years ago. He tracked his investments as if assuming he had kept his old investments just as a comparison. I mean, he was an engineer doing spreadsheets. That was fun for him. In his case, it was like 12 years before he would have gotten back to where he started. So he would have lost 10 years of time, and he had just retired. Do you realize if you retire, particularly, my gosh, when you first retire and you get to suffer a market hit, that's when it actually hurts the most. He was able to avoid that. Those are the types of things I do for people. We put together a plan. We take a holistic approach. I mentioned not only growing the money, we also eliminated the downside market risk. We took care of, long-term care type needs. Some of the money is tax-free, by the way, so we reduced his taxable liability, so he's paying less in taxes than he would have in retirement. All these things are addressed. So I guess I want to stress two things here. If you have the common misconception that guarantees equals less return, you need to dispel that myth. It only applies if you're in poor products or poor indexes. I will show you the better indexes. It is about a 80-20 rule. 20% are great. They average double digits consistently over 10, 20-year periods. We'll get you in those and consistently keep you in those kinds of indexes because we got the performance reports to track that and keep track of that. 99% of advisors and agents don't. They just don't. They're not. Why? Most of them don't even know it exists. I didn't either until I was introduced to it. I even had one client recently went back to her agent and then the company and asked them what were the performance reports, index performance reports on her annuity that she had. And they looked at her like deer in the headlights. She said they didn't have any idea what I was talking about. I said, exactly. That's the game changer. That's the difference. And if you're concerned about locking your money up for a period of time, the market value adjustments, which adjust your surrender schedule, are so good now because the profits of these insurance companies are so much better than they were because the bond yields, every expert is predicting going to continue for the foreseeable future, next 5-10 years at least. They're so good that these surrender charges on like 10-year products are disappearing in a year and then some, just like the client I shared in the first segment, where not only there was a 10-year product with a 9% penalty in the first year, and not only did the market value adjustment wipe that out completely in 1 year, they were $14,000 ahead on a $315,000 account if they decided to close it out after 1 year. So what I'm saying is these products are so much better now. It's a golden age of fixed assets, best time in 40 years. I haven't seen one that a surrender charge is applied beyond 1-2 years maybe now. These are 10-year products because of the market value adjustments. So the limitations that you may have heard about or that are common misconceptions out there are old news. You need to dispel the myth and learn what's really going on. Learn how to grow your money, unlimited upside, no downside market risk. I'll show you indexes that have averaged 11% plus over the last decade plus. I'll show you how to get in those and stay in those. Each year you lock in the gains, you keep them regardless of what happens in the future. And the market value adjustments, again, are so good that the surrender charges are disappearing in 1, maybe 2 years. If you wanted to walk away, you could walk away with all your money and then some. If you want more information on this, contact me at yourpersonalbank.com. In the next segment, I'm going to share with you a meeting I had with a client that had a target of how much income they needed to earn in 3 years in retirement and how he did it.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me at yourpersonalbank.com, yes, you'll reach me, or the Your Personal Bank app. It's yourpersonalbank.com. If you've been considering an index annuity, or you own one and you're not seeing double-digit returns on it, you need to contact me. I just did a review yesterday with a client. They got 20% returns last year. This is what I'm seeing consistently. So if you're not seeing the same thing, contact me at yourpersonalbank.com. But what are some of the other things I do for folks? I had another very interesting meeting this last week. I told you it was a great week. Had a lot of fun. This client contacted me. He had various accounts, investments, and such. He wants to retire in 3 years. He's determined how much he's going to, him and his wife will receive in Social Security starting in 3 years. And the bottom line is he wanted to receive $8,000 a month income 3 years from now. So I have a software program that can help us reverse engineer that quite quickly, quite simply. So I showed him he had in place what he was doing with his portfolio. We assumed a 7% return on his portfolio over the next 3 years. We assumed a 4% withdrawal rate when he was retired, which is what's recommended. And what this program sped out and showed is he only had half as much money as he needed to be able to receive that $8,000 a month income. He had about almost $900,000 in total assets. And for him to be able to accomplish that $8,000 a month in 3 years from now, he was going to need almost double that. Well, why is that so important? One, you need to know where you're at, and you have to set realistic expectations. Also, you can then determine how to make changes or adjustments. One of those adjustments would be, well, he could work longer, and that was an option he did consider. Another is you could increase the withdrawal rate. But here's the problem if you have assets at risk and you increase the withdrawal rate. These are called Monte Carlo simulations. These are basically computer simulations that are run thousands and thousands of times to determine what's the likelihood of a success of you outliving the money in retirement. And why the Wall Street and the financial industry tends to recommend a 4% withdrawal rate, these studies have been done, and you can look at them doing all types of different, say, equity and bond splits, anywhere from 20-80 to 80-20 and everything in between. 60-40 tends to be the most commonly recommended equity to bond portfolio split. That's based on modern portfolio theory. It's been around since the 1950s. Well, if you take a 60-40 equity to bond portfolio mix and you use a 4% withdrawal rate in retirement, the Monte Carlo simulations state that your likelihood of success of not running out of money in retirement is between 85 to 90%. So you have a high degree of likelihood of success that you're not going to run out of money, 85, 90% chance. By the way, if you increase that percentage, your likelihood of success, your confidence goes down quite quickly. For example, with a 60-40 portfolio, if you increase to 5% withdrawal rate, you realize your likelihood of success drops from about 85% down to 65%. So you've got about a 2/3 chance of likelihood of success, which means you have 1/3 chance of failure. Failure means you run out of money. That's not a good thing. And if you increase your withdrawal rate to 6% on a typical portfolio, you're at about 45%. You're less than half. So that's why it's really important not to take too much money out of a typical portfolio. Now, there's a better way, in my opinion. Why is the likelihood of success drop so significantly? Is a typical portfolio, and this is based on good markets, bad markets, in between, every scenario you can imagine. A lot of it has to do with when you retire and when you start to take the money out, is the markets going up? Are your assets going up in value, or do you suffer a correction? If you suffer a correction, let's say within 5 years of retirement or 5 years into retirement, so that decade is key, is critical. So about 5 years before you retire and about 5 years after, if you suffer a correction, 20% or more in that time frame, your chances of a success drop significantly. You get hit, and it's called sequence of returns. It's a mathematical concept. And let me use a quick example. Let's say you had $1 million retirement account, and you had suffered a 20% drop. That's a normal drop. So now it goes from $1 million to $800,000. Now you're taking the 4% withdrawals, right? Because you're retired. Well, that first year, that would be $40,000 on $1 million account. So not only did your account value drop from $1 million to $800,000, but you also took $40,000 in income withdrawals. So instead of an $800,000 account, you're now down to $760,000. You've dropped almost 25% in 1 year. Combination of the market correction and your withdrawals. How are you going to recover from that? Because the next year you're going to take another $40,000 or so, right? 4% withdrawal rate. If you are in that situation, you continue taking that withdrawal rate, you stand a fairly good chance of killing it. It won't be able to recover. And if you go higher than 4%, 5 or 6% even, you stand a great likelihood of killing that retirement portfolio. That's the nightmare. If it happens before you retire, well, maybe you can keep working so you don't start withdrawing. That's why a lot of people after the most, correction and recessions, people nearing retirement keep working. That's the reason. But if you've already retired, most people have two choices: go back to work or suffer the consequences. Well, what if you could invest and you don't have risk of losses? In other words, you could still make the gains, the upside gains that a typical index would, like these index annuities I refer to quite often, but you don't have the downside risk. So let's take the same example. You've got $1 million retirement account, like the client I shared with last segment that I met with 19 years ago in 2007. Well, remember what happened in 08 and 09, right? I saved him from that. Kind of proud of that. He's not the only one. I have a bunch of people like that. But the bottom line is, have $1 million retirement account, market drops, you still got the $1 million. Yeah, maybe you still took the 4% withdrawals, but your account didn't go down very much. And now when the recovery occurs, you recover from the higher point. That's why Warren Buffett is famous for stating most people, think you have to maximize returns. No, it's more important to protect against loss. But I can do you one better with the index annuities and the IULs. We can increase your rate of return. Instead of returning 4%, you realize you can withdraw. Instead of withdrawing 4%, you realize you can withdraw 6 or 7% safely with many of these index annuities and IULs, sometimes even more. Why? It's really simple. You don't have the risk of suffering a loss. Let me give you a quick example. We've got indexes that have averaged 11% plus for the past decade. And I have clients that have done this, taking 10% a year. Now, I'm not saying this is necessarily the best thing to do, but has their account value gone down? No. Could you take 10% a year from a portfolio? Most cases, the answer would be no. And would I recommend a 10% withdrawal rate? It's not ideal. Only if you have to, you know what I mean? But let's say we can pull it into 6 or 7%. These index products comfortably return 7% plus on a regular basis, on average. Review I did yesterday. Their anniversary was February 11th of 2026, and they got a 20% return last year. They're taking a 6% withdrawal rate. Are they doing fine? Yeah, they're doing great. Their account's up 14%. And next year, if the market corrects, well, they don't lose. They're still up. You see the difference? You don't hit that situation where you're withdrawing money in retirement and then you get hit with this big cut, reduction, correction because of the markets. As I stated earlier, with his current plan, his current portfolio, he has almost $900,000 and he needed nearly double that to make sure he could have $8,000 a month income in 3 years in retirement. By using an index annuity and be able to increase the distribution rate, the withdrawal rate to 7%, we were able to cut the amount of money he needed to earn $8,000 a month down to $568,000. About a third of what he needed with his current plan because his money was at risk to market loss. And this one we can have a much higher degree of likelihood of success because we know there's no downside market risk. We know there's no downside. So the likelihood of him achieving that $8,000 a month income in 3 years, based on what he has to work with today, is much, much greater with about a third of the amount of money he would have needed with a 4% withdrawal rate on a typical portfolio that's subject to market risk. So we win on two fronts. He can start with less and end up with the same amount and withdraw more per year when he is retired safely. For those of you that might even contend that, I'll take it one step further. I can show you guaranteed lifetime income products that would guarantee him that the $8,000 a month income guaranteed for the rest of his life. Any of those doubters out there, we can guarantee it. Now, again, I'm not saying that's necessarily the best direction to go. Some people, yes, others, no. But I just want you to understand some of the things that I can do and how we can improve whether somebody's looking to retire and, hey, I need $8,000 a month to retire on. And how much do I need to contribute to make that happen? The fact that he needed 1/3 of the money to accomplish that versus his current plan in the markets. Do you think he was happy about that? Understand, he's been getting good returns on his investments previously. That's not the problem. It's not about his returns. And by the way, the returns that the index products have been giving were similar. He's been getting about 11%. So have the index products, but they have no downside risk. Well, if you've got two investments with similar returns, let's assume everything's similar. They've got the history of the last decade making similar returns, but you got no downside risk in one option and the other you do. I mean, which one are you going to choose? That's the difference. So if you want more information, contact me at yourpersonalbank.com. Stay tuned in the last segment. I got some economic news I need to get to, so we'll get to that.
This is Ferenc, host of the Your Personal Bank Show. Great news. Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com or the Your Personal Bank app. Yes, you will reach me. It's yourpersonalbank.com. Before I get into the economic news of the day, if you missed the previous segments, I shared some stories with some clients I met with this past week. Some of the most interesting meetings I've had in a while. One of my clients I've been working with for 19 years. Tremendous story. Another one did their first 1-year review in their index annuity, got a 20% return this first year. By the way, if you have an annuity and you're not seeing those kind of returns in the last year or so, you've got the wrong product or the wrong index. You need to contact me, yourpersonalbank.com. And even if you've got a penalty, I can show you how to offset that and get out of that and get better returns and double, triple, maybe even quadruple the returns you've been getting. Stop staying where you're at. Stop suffering. Start getting what you could get, okay? I can show you how to do that. But the economic news of the day, here's why I'm concerned and why we may see a recession or something, because record debt keeps piling up because of the rising cost of living. Even though inflation has slowed down, the rate of increase has slowed down, which is good. It's still increasing. It's still going up at 2.5% or so a year. And that's after suffering, previous 4 or 5 years, about a 30% rise. Household debt has spiked to a new all-time high of almost $19 trillion. This was as the end of 2025. Mortgage debt is over $13 trillion. Credit card debt, also a new record, $1.28 trillion. Auto loan balances, new record, over $12 billion. Student loan balances, over $11 billion. Home equity lines of credit, over $12 billion. These are all records. In fact, total household debt has now doubled over the past 20 years. Americans are taking on debt at a record pace. This is not a sign of good economic times going forward. This is going to impact things. Certainly, we're seeing like we're seeing the markets with volatility and such. I believe we're going to see more of that, at least, and maybe even a correction. But some other things, particularly in the real estate world, rents are dropping fast in many of the markets that got overbuilt. It's all about supply. And also, don't forget, we have a lot of people leaving this country. For the first time in over 50 years, we have fewer people in this country than we did a year ago. Phoenix, for example, is leading the charge. Average rents have now dropped over 17% since the peak in 2020. Austin, 16%. San Antonio is 13%. Denver, almost 13%. Pittsburgh, almost 11%. Salt Lake, about 10%. And Atlanta, 8.5%. Many of you know I have worked with many real estate investors over the years. Many of my personal bank clients, from the high cash value policies to grow the money insured, tax-free, highly liquid, and create positive arbitrage. It's a favorite for real estate investors, all type of investors, business owners, things like that. It's a positive. And I should take a quick aside here. I get asked this question all the time. I talk about the personal bank policies. I talk about index products. I talk about IULs, annuities, guaranteed lifetime income riders. These are all different products that I deal with, and it depends on the need of the person. And in a general rule of thumb, the personal bank products are really good for people who are what I call active investors, business owners, real estate investors, people that need access to capital because you can access from the policy, borrow against it, get positive arbitrage because you're earning more in dividends or interest than you get charged in interest typically. So it's great for your people that are active investors. Again, entrepreneurs, business owners, such like that. But most people I deal with actually are passive investors. In other words, they're just putting money away to supplement retirement. That's where index annuities really shine. IULs, because they tend to be a little bit longer term, good for putting money away, growing, tax-free, highly liquid, long-term growth. Now, IULs and cash-paying dividend policies are also good for living benefits like long-term care, having death benefits, and growing your money tax-free. So if somebody wants to reduce taxes, then we get into those areas too. But general rule of thumb, you want to think your personal bank policies, positive arbitrage for those active investors, people that are doing stuff, need access to capital, business owners, real estate investors, those type of people, or folks that want to get positive arbitrage to invest in other assets. Passive investors, people that want to just put money away, grow the money, supplement retirement. Index annuities are one of the strongest products you can do, unlimited upside gains, no downside risk, and they're really, really good with IRAs, traditional IRAs in particular, because the limitation I shared within the previous segments where there's early surrender charges. Well, with an IRA, you've got tax hits if you take a bunch out. So the surrender charges are far less than any tax bill would be. So the limitation on those just kind of disappears with a traditional IRA. That's why we use index annuities with IRAs constantly, because they're like hand in glove. They work together so well. Also, if you listen to the previous segments, you heard where the market value adjustments are so good lately in the last couple of years that most of the products, when I'm doing reviews, people's surrender charges are disappearing in a year, maybe two. The company does better than expected, and they reduce your surrender charge or eliminate it. And most are getting eliminated in the first year. So that limitation of annuities has largely disappeared. Another myth to dispel. But back to the economic stuff. I got into rental properties and I got a sidetrack. I have a lot of clients, my real estate investor clients, who are now selling out and getting out of the business. I'm selling all my rental properties. This was an email he sent to me. Your clients are thinking about buying rentals right now. You might want to step back and ask yourself why. Because with today's interest rate and high home prices, cash flow is tighter than ever. There is real economic uncertainty. Growing your money safely right now has significant value. Think about your risk tolerance and just a few things to consider. And this was a message he shared with me, kind of wanted me to share with other real estate investors or potential real estate investors. You know, if you listen to this show, I've been really high on real estate investment. And if this is your thing and you're a pro and you're good at it, great. But if you're not, this is the toughest time ever. If you're thinking about getting into it, you might want to wait. You might want to reconsider. Prices are high, some of the highest they've ever been. They are coming down. Equity decreases are coming down. Like Florida, we're seeing average $37,000 loss. Arizona, $28,000. Washington State, $32,000. Georgia's been $18,000. Texas, $26,000. That's the average equity loss in the past year in these different states. There's nothing showing that that's going to slow down because buyer demand has hit at the lowest levels ever recorded. There's a housing demand index, and it has a rating of 0 to 100, and 50 is average. It's now recording at 5. So it's 10 times below the average buyers, housing demand. And like they pointing out, the only thing that's going to increase home buyers' interest is going to be a major price drop. And the reason why this is the case is, in 2005, the average salary, it was $46,000, and the average house price was $184,000. And today, 2026, median salary, $59,000. Median house price is $450,000. So the average salary in the last 20 years has increased by 28%, while the average house price has increased 150%. That's the dichotomy. That's the problem. The average house today is 5 times annual income, which is an all-time high. And according to Realtor.com, the only way home buyers are going to return is mortgage rates are going to have to fall to 2.65%. That's highly unlikely. Incomes are going to have to rise 56% to a median of $132,000. That'll take a while. Or home prices are going to have to fall 35% to a median of $273,000 to get back to normal. And that's the most likely scenario because the number of unsold completed homes for sale has now hit the highest levels since 1999, with the exception of the housing boom that occurred in like 2006-07. Outside of that boom, we're at the highest unsold completed homes for sale now since 1999. What's also interesting, I thought, was U.S. housing starts just hit a 5-month high. So home builders are still building, even though there's already excess inventory in many of these markets. Well, that's the very thing that's going to cause housing prices to drop, is inventory. We've got some real uncertainty ahead. Americans have taken on record levels of debt, doubled in the last 20 years. Housing prices are still, although declining, near all-time highs. So the likelihood of them continuing to do that are very high. Rental prices are dropping, especially in the areas that's likely going to continue. This is the first year in over 50 years that the United States has fewer people in it than it had the year prior. The estimates are there's about 400,000 less people in the U.S. today than there was a year ago. This is based on all net inflows and outflows. The projections are for 2026 to be about 1 million. Well, that'll keep pushing rent prices down, and that'll also help alleviate some of the housing shortage. And as I stated earlier, home builders are still building, so home prices will continue to drop because there'll be more inventory. And the vast majority of Americans just can't, if you're trying to buy a home, can't afford it because the average home is 5 times the average salary. And that's just unsustainable. So we're going to see a lot of changes. Change involves volatility, uncertainty. Do you have the stomach for it? This could be a rough ride, folks. If you're involved with investments that are subject to market risk, we saw a tremendous run-up with silver and then right back down. It went from the 60s up to over 100 and back down to the 60s in a month. We're going to see more of that type of stuff, I believe, going forward. If you don't want to ride that type of roller coaster and you want some certainty, you want to protect your downside, you want to get strong upside gains, unlimited upside gains, in fact. If the markets continue, indexes continue to go up, great, you're going to get it. As I stated earlier, my client got 20% last year. Locked in. Doesn't matter what happens next year. They get to keep it. If that sounds interesting to you, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show. And as long as it's on our money, in God we trust.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information.
I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.